Hello, hello, hello. What's going on? How's everybody doing today? Welcome to Al Stock Trades. Okay, ladies and gentlemen. So lots of stuff happened today. We got the CPI report. We got the FOMC meeting. Now, just as I said yesterday, we made a video 22 hours ago. We can zoom on here and we can see. And I said, ladies and gentlemen, we believe that the CPI report's going to come cold. Right? It's going to come cooler than expected. The Feds are not really going to be increasing or decreasing interest rates. They're going to keep interest rates at the current rate. And we believe this will lead to a stock market rally. Would you look at that? The S&P 500 closes above 5,400 for the first time as the Federal notes modest inflation. You read here, S&P 500, NASDAQ, falls to record after cool CPI and Fed decision. All right. There's going to be a lot of people out there that don't know the stock market. Okay. They're going to say, oh, I'm bearish and all this other bullshit, right? These people don't know. Okay. I'm telling you, I have access to some really cool information and I have access to institutional types of data that even I can't even fully release to the stock terminal, but I am the vessel of the message. And when when I say something, especially in that research edge, it's backed up by a lot of data. It's not just coming out of my booty, right? So as you can see here, we're doing pretty damn good. The market is starting to shift under our feet. And this is the step forward we need for that crazy bull market that we've been waiting for such a long time. Some people say it already started. I think it already has. A good example here is take a look at Jumia, right? Jumia is, they call it the, Amazon of Africa, right? This thing went ahead and it's been bouncing off its 200-day moving average to a point where intrinsically, it was somewhat near its bottom. And then all of a sudden it bounced all the way up from $2 to, near its $10 region. So you could start to see, and again, this company went to $60 back in when the heydays during the low interest rate. So if you go to Jumia here really quickly, you could see if we were to kind of go here, let's go here, right around this region, you can see it's up, 325%, which is a 3.2 bagger, right? So we're starting to see that risk on is starting to kind of come back because I think from my recollection, this is still a negative free cash flow business, right? But again, there's a lot of potential given the future prospects of Africa with this increase in GDP in reflection to potentially kind of like how India or maybe even China, which is insane, right? So overall, the market's doing really damn well. That's pretty much in that regards. If you look at the consumer price index, you can see that it has been pretty much dropping here, and we're getting closer to the Federal Reserve's target of 2%. I believe that there's going to be one interest rate cut this year, and we're going to have the Federal Reserve is expecting approximately 4 to 5 in 2025. But remember, return to growth most likely is going to happen in 2026 for Clover. 2025, they're saying potentially, but it's more the counterpart assistant to help offset that down regulation and star ratings for that 3.5 3-star rating down regulation. Now that Clover is more predictable on the Medicare Advantage side, I wouldn't be surprised if they go to 4 stars, but I think 3.5 would be a stepping stone back into the norm right there, right? So overall, guys, this is exactly where we need to be. This is day 2 of Clover Health over $1, and we're getting there. I mean, this thing literally bounced 16% off of this kind of V-shaped bounce around 90 cents. And kind of let me go ahead in here and kind of have to fix this here and just kind of increase the scale here, stretch it out a little bit. So let me just kind of stretch this out so we can analyze this. This is the daily. Am I doing this right? All right. So just trying to like stretch it out here. so we can see it. I'm sure you can right click it and fix the axis, but this way is fine. Do it the old man's way. All right, good. So the stock in general has had some issues keeping above its 200-day. This is Clover, keeping above its 200-day moving average. So now this is the test. If you could zoom here, we went down, but then now we rebounded above that 200-day. If this becomes kind of the solid, we should expect to see a golden cross, and that's pretty bullish, right? So last time that happened, approximately, it shot up to $1.64. Okay, so we talked about this. Now let's go ahead and talk about kind of something interesting here. So if you don't recall, no, that's not it. There it is. If you don't recall, I talked about kind of the wheel strategy for options here. Oh, how you doing? How you doing? Go wagon or go, yeah, go wagon. Yep. So we're going to be talking about this, and this is a very, very exciting thing I want to talk about. This will be phase 3 of the Mastering Stock Market course. Is still in beta. We already have the data now to support this, but this will be phase 3. So definitely take advantage of the coupon code SAS for the our Mastering or Bundle lifetime access. It includes lifetime access to the stock terminal. You can see all of the data here, so take advantage of that. These are all the commands, right? So what I'm going to do is I have this kind of document, and I was looking at the options chain yesterday, so it may have changed today. It changes every day, but on average, we're going to go ahead and kind of go through this. Let me just have some sip of coffee. Okay. Excuse me. All right. So it's nice to kind of draw this out, but I'm going to just kind of verbally say it, and then maybe we can can we draw something out here? Yeah, no, I don't think so. Maybe we can say online drawing tool. You do this. Maybe free. Because I don't want to bring out my tablet here. It's going to take too long. Auto draw. This sounds nope. Start drawing. Okay, good. So we can start, honestly. So I'm going to do this with my mouse, so it might look ugly. So let's go ahead and kind of draw a Cartesian plane. That's a terrible Cartesian plane. So our Cartesian plane, just fancy word of drawing the X and Y axis. Okay, I'm doing this with my mouse. Okay. So right now, Clover is trading at $1. Okay. And if you were to look at the strike price for if you were to look at the strike price on August 16, I believe, of $1.50 from yesterday's date, this thing is paying approximately 7.2%, meaning that if we were to say, for every 2 months, because how many days is August 16 away from? Well, it's around 60 days approximately. So we could say, every month, Clover's premium is approximately 3.5% per month. So if you were to extrapolate this out, multiply it, that means, let's say per year, you take 3.5 times 12. And again, this changes, right? But it pays around 42%, which is kind of a wheeler's dream, right? Around that, right? And sometimes, I've seen stocks pay higher. So now you're like, Al, I don't believe this. This is too good to be true. Now, normally we like to start by selling puts, but I'm going to speak from the perspective of people already own the stock. Okay. So the strike price, I'm going to put it up here. exaggerate it up so we can kind of illustrate. The strike price is $1.50. And again, I'm using my mouse to draw this, so it kind of looks ugly. I'm sorry. So this is kind of the line that you want to monitor in regards to the strike price. Okay. So let's say, and let's use green as the kind of the up and down of the stock. Let's just use black. Let's use black. Okay. So the stock price, if it goes ahead and let's say this is right here is August 16. Terrible, terrible drawing. Fucking, where's the eraser? I've never used this software here to. No. Is there an eraser? Phil? There's no eraser? Auto draw? What's auto draw? No. Come on. Do you guys see an eraser on here? Am I missing something? How to? This, I mean, this ain't rocket science, but where the hell is the eraser? Man, that's some bullshit. All right, so I guess I'm sorry. Excuse my language. Like, what the? Where the hell is the eraser? What the hell? Okay. Huh. All right, whatever. I just won't mess up. That's 16. I just am not satisfied with this 6. Anywho, well, we need an eraser. That's the problem. I guess we can do this. Undo. We could just do that. We'll just undo it. It's okay. So I'm going to try to draw a better 6. Yeah, that's decent. So now, sorry for the little distraction here. Okay, so let's say yesterday, whatever, I entered into this options here, and I want to go ahead and I want to sell a call, right? This is called a covered call. What am I covering it with? My blood, right? No, I'm covering it with my shares. I already have shares in this company. Okay. And let's say, as soon as I say, I have a contract I'm going to sell for $1.50 strike price, meaning that if I'm going to play it out for you guys, meaning that if the stock gets to $1.50, I have to sell. Immediately, I get my premium. Immediately, as soon as I do the contract, I get the money deposited in my broker's account. So I have that cash. I can go spend it in Las Vegas. I can go, buy more. I can sell puts. I can do whatever. That's my money, right? Okay. So let's say, for example, the stock price goes down. Okay, that's fine. I keep the premium and I get to keep my shares. Isn't that like holding? Okay, great. Let's say if the stock price doesn't go down, just stays the same. Okay, that's great. I get to go ahead and keep my premium, which I already do, and I get to keep my shares. What happens if the stock price goes up near it, but doesn't really cross it and then stays right there? Okay, that's fine. I get to keep my shares and I get to keep my premium. Let's say if it goes ahead and crosses and it goes down here. That's fine. I get to keep my premium and I get to keep my shares. Unless it's a dividend paying stock and the dividend is higher than the actual premium. You got to monitor those dividend stocks. I don't want to overcomplicate this. The shit can get really complicated. I don't want to complicate it. You could just forget that. Clover's not a dividend stock. You don't have to worry about it. Okay? All right. Now, let's say, for example, it goes ahead and it goes, and all of a sudden it goes up, and then it closes at $1.50. It closes at, let's say, $2. I know it's not the scale here. All right, that's fine. I get to keep my premium. I always get to keep my premium, but I have to sell my shares at $1.50, not at $2. Okay? So you see that? So that's called a covered call. Okay? Now, let's say, for example, I like let's say, for example, I'm out. I don't have shares anymore. I have all this cash. That's fine. Now I can do a cash secured put, meaning that if the stock price drops below $1.50, I will buy it back. So let's run this example. Okay, so let's go ahead and kind of extend this red line here to run this example. And I'll probably draw it a little better here. But so now let's go ahead and see this part. Okay. So let's say, for example, I'm like, all right, the stock is $2. God dang it. I went ahead and I don't have my shares anymore. I have all this cash. And Clover is like $2 now, but I sold it at $1.50. Yeah, I got to keep the premium and everything, but now I really want Clover, but I don't want to buy Clover at $2. I want to buy Clover at $1.50. That's fine. You can sell a cash, because you have cash, secured put. Okay. So let's say, for example, Clover just goes ahead and just stays at $2. That's fine. I get to keep the premium, and I don't have any shares, right? Because it didn't go below $1.50. Let's say if it goes down here, but then goes up at the, okay, that's fine. It still closes above that date I want. So the date's down here. Okay, that's fine. Okay. I don't get to keep, I don't buy shares. I get to keep the premium. Okay. Let's say it goes down near it, but doesn't go across it. Okay, that's fine. I don't get to buy the shares. I get to keep the premium. Let's say, for example, it does cross and it finally goes in right on that date. Okay, great. Bingo. All right. But let's say it closes at $1.20. What is this? $1.20. All right, that's fine. I'll own it at $1.50. I still get to keep the premium. That's fine. Then guess what? I can reverse it. I can do a covered call at $1.50 and play the same bullshit game over and over again. Okay. So let me go ahead and kind of redraw this out. So Jonathan from oh shit. Okay, that's fine. So, one of our members talked about this. Like, Al, I don't really feel comfortable doing a covered call at $1.50 because I really think it's gonna hit. Kind of looks like an eyeball, the eyeball of truth, right? So I think it's going to hit $1.50 in the next 2 months, August 16th. So I'm not comfortable selling at $1.50 because, I think it's going to go higher. Okay. That's when you do intrinsic value, technical analysis, all your things, right? There's a lot of like Greek symbols you need to learn for this, right? So that's understandable, right? So let's say, can we get a new sheet? How do I get a new sheet? Can we get a new sheet? Really? What is a little button here? Can I get a new sheet? Wow. No worries. I'll just open up a new tab. Oh, doesn't let me. Huh. Wow. That is. I'm gonna make this kind of small, and I'll use it later. Can I? Okay, I'm just gonna delete it. Sad. I worked so hard on that image. Hopefully it's okay. Did it update here? Good. All right, good. So let's kind of give this example now to people. So the first things you want to do is you want to find a stock that you like. Microsoft, Tesla. Tesla's kind of a little bit off, Apple. Stocks that are not going to go bankrupt, right? Stocks where the fundamentals. And let's say, for example, a stock's trading at $100, okay? Or $10 or $5, whatever. Okay? I guess in the purpose of retail, we'll just say 10. Okay? So let's say you like the stock at 7. Because you like the stock at 7. You want to buy at 7. And let's say you want to go ahead and do a cash secured put, meaning that if the stock price drops below 7, you are comfortable exercising the option to buy shares at this price. But guess what? You got to look at this because some don't pay this, but in the purposes of Clover, it pays approximately a 7% dividend every 2 months, which is approximately 40% every year. Okay. And that sometimes changes. And I think it's going to go up once the stock goes crazy. The cool part is let's say this company stays at $10 for like a year. I don't think it will, but guess what? You get the every 2 months you're going to be making 40%. Okay? So every 2 months you'll make 7%. 7%, 7%, 7%, 7% every 2 months, 7%. Okay? So then let's say, for example, yes, finally, you got called for it. And now you own the company. What is this? Now you own the company at $7. Okay. Hold on. So now you own the company at 7. And let's say you're comfortable selling at 15. You're like, you know what, man? I'm comfortable doubling my money on this. So you can go ahead and there's your line. And then you can, because you were selling puts, right? Cash secured puts. Now you're going to go ahead and sell covered calls. Again, I'm not buying calls. I don't do that, right? I don't buy calls. I don't buy options, right? People lose money in that. You can make a lot of money with that. That's what Warren Kitty's doing. I don't do that, right? So anywho, so you go and do this. And let's say, for example, for like 3 years straight, this company's trading sideways. Everyone's going to be, oh my God, I hate the stock. The stock. No. This is great. In fact, you want kind of a little bit of volatility here. The more volatility is great, right? Well, let's say it never hits $15 for like 2 years. Dude, you're selling covered calls every 2 months, sometimes every month. The options chain, you got to look at it. It's going to look juicy. And you're going to be making approximately 40% every year. Holding a stock and that you're comfortable selling at 15, you're just going to have fun with this, right? And just kind of keep selling, and keep selling those covered calls and go pop, 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 pop. Okay. We're going to be showing, I'm going to be doing this on the stock terminal. I'm not comfortable doing the $1.50. I think it's going to go higher, especially with the SaaS deal, right? But we're going to be doing this in the future so people can see kind of what's going on here. Okay. And let's say after 2 years it hits. Okay, that's fine. It goes to 18. I don't care. I'll sell a put at 15. And I'll keep selling put at 15, 15, 15, 15, and collect all that premium until it goes down and I get it at 15. And then I'll do another one at 20. I'll sell a call and I'll collect premium up until I have to sell. And I keep reversing the process over and over and over again. Now, what people do that's not good is when they sell puts, they use margin to sell puts. You want to, those folks know what they're doing. Some of them do. I don't know about all of them, but I stay away from margin. I don't mess with margin. Okay. I don't mess with money I don't have. Okay. Unless I have properties to back it up. Right. So I can like pull out a HELOC loan. Right. Sorry, I just spilled coffee on my mouth there. So I'll kind of give you an example here. So let's say Clover now. Let's do another example, because the more examples you see, the better you get it, right? So that's a long line. So let's say Clover's 15, and I'm going to exaggerate this. I want to do a covered call at $25, right? And I'm comfortable. My Clover's intrinsic value. Okay, let's say I'm comfortable. 25 is perfect. So. And I keep doing this and I collect the premium, let's say, for 3 years. 3 years, I'm making 40%, man. Could be even more. Could be less. Depends. If the VIX is high and there's volatility, it's actually better for you. Okay. VIX, Chicago index and all that fear, right? We talk about all the time. But let me just kind of give you an example here. Every 2 to 3 years, there is a correction. Every 7 to 10 years, there's a recession. 2014, a little bit of a correction to a little bit of 2016, right? 2018, there was a correction. 2020 was a recession. 2022, there's a correction to 2023, right? So every 2 to 3 years is a correction. Okay. So let's kind of like play this out. So let's say, we sell a covered call for 25. Okay. And this thing doesn't even hit For a good 2 years, it does not hit 25. That's like 2 years. That's fine. I'm making money. I'm making premium. Problem is the premium's taxed at a high rate, depending on your tax bracket. But don't let Uncle Sam preclude you from making money. You're still making money, okay? So let's say it hits. Yay! Okay, shares are closed off. Okay, you own it. But now let me just kind of give you an example. So this is kind of an example here, okay? So what do you do with this premium? What do you do with this? Some people go in and they're like, I'm going to take this premium and I'm going to sell a put at $11 or $12 or whatever. Meaning that I'm taking this money, I'm saying I'm going to tie up my cash at 11, saying that if Clover goes down to $11, I'm going to go ahead and I want those shares at 11. But it has to drop down to 11. So now what you're doing is you're doing a nice hedge, right? It's called hedge. You're going to start seeing a lot of hedge funds. Citadel, they all do this, right? So now I'm selling a covered call up top, and I'm selling a cash secured put on the bottom. So if the thing trades sideways, right? Hello. How are you doing here? Good evening from UK. Al, can you say hello to Swahili? Right? Hello. So you could see here, I'll be making, so what I'm doing is the original cover call is, if the stock doesn't go to $25, I get my premium. I'm sorry. I get to keep my shares. I get to keep my premium anyway. Okay. So I get, this thing can go up and down, but guess what? I take the premium, and what people do is they go ahead and sell a put. And if the stock doesn't go down to 11, guess what? They could still sell puts and they can still sell covered calls. And all of a sudden, you start taking the premium from the covered call to put in the cash secured put, and you just make your own little strategy here. There's one way of doing it. I've seen other people do it this way, and I think I like it this way. I mean, it depends what you like. I mean, both ways are great, right? I kind of like it this way because this way is kind of sexy, okay? So let's say, for example, you have all this money and you get all this premium, okay? This is wonderful premium, okay? You could take this premium and you're going to get some crazy cash, especially if you have a lot of share, especially if if you have a multi-million-dollar account, you take this premium and you buy homes. What? You buy a home? What do you mean? You buy home straight up cash. Like, what? Are you crazy? Are you stupid? Yeah, you buy home straight up cash. Looking for a nice investment around rate of return, 8 to 15%. Obviously, that doesn't include vacancies and all this other stuff you have to calculate. But guess what? You have straight up cash. And let's say you have tenants. You are straight FCS positive in this business now because there is no mortgage. All you got to do is pay your property tax and bullshit, right? And hopefully you'll have all that money coming in from the home. But let's say, for example, there's a recession. So you take all these premiums and you buy a bunch of homes. So let's say you do this for like 5, 6 years, 7 years, whatever, and you have 10 homes. And let's say the market tanks. The market crashes. Okay, the market crashes. Let me kind of make it a little bit more realistic. The market crashes down here. $5. Okay. Guess what? What happens when we have a recession? Federal Reserve comes out. They go ahead and decrease interest rates. Interest rates come to zero. You know what you can do? Then you could go to the bank, tell the bank, say, hey, I want to get a loan on my house. They're all paid off for. Give me the lower interest rates loans. You pull out debt from your houses. And the cool part about this debt is that, let's say after 10 years, your houses went up 2% year over year. So you have capital gains on the house. But guess what? Debt is not taxed at capital gains. You can't tax debt. See the loophole here, right? So you could take this debt now, which is fine because it's just the house that you already paid off. Now you're just getting a mortgage on it. Your tenants are going to be paying this mortgage because you're going to insure that you're going to be able to be free cash flow positive. You're going to make sure you're business savvy, right? Then you're going to take this debt that's at, let's say, 2% or 3% or whatever, right? And your customers, your tenants are paying the mortgage. You take this debt and you sell a put at, let's say, 3 or whatever, and you collect premium now on this debt while simultaneously keep selling those covered calls. And then once you get into the money with these, let's say it does hit $3, you take your debt and now you just sell covered calls until the market recovers, which it will. It's America. Market recovers, right? You don't bet against America. Market recovers. You double the crap out of your money here. You double the crap out of your debt, right? Which is your, mortgage, right? And then, you could do whatever. You could go ahead. I personally won't pay off the mortgage because it's going to be a low interest mortgage. Let the bank hold that bag and let your tenants pay off the mortgage. Ladies and gentlemen, what I'm describing to you is how you make money in your sleep. Okay. So again, this takes time. It's what happens when you surround yourself with a lot of people, with a lot of wealthy folks. You learn a thing or two. And I've learned a lot of this, some from my father-in-law, future father-in-law, who does real estate, has a lot of properties and whatnot. And then some with just kind of the stock market as a whole. But you can kind of see the general theme here, okay? So who gets the short end of the stick? Sadly, the tenants, because they always have to pay rent, right? So what you do is, you sell covered calls, you get your premium. You could go ahead and do cash secured puts, which is fine. Or you can buy homes and diversify just to protect you against a recession in the stock market. Then once the recession happens, there's interest rates go down to zero. Then you have cheap ass homes, mortgages, right? Home prices go up because of these ability for people to buy. You pull a mortgage on your home, doesn't matter. Tenants pay off the mortgage. You don't have to do anything, right? Instead of free cash flowing now, tenants pay off the mortgage, which is fine. You still have some free cash flow, right? Plus you get to depreciate your homes exactly, which is a tax write-off, which is insane, right? And you get to depreciate it. And you could buy bigger homes and do a 1031 exchange. That just kind of make things, I don't want to make things complicated. Things can get really complicated here. Not complicated. I think they can get more fun, right? And then you get the debt and you sell cash secured puts as the market's going down. The premiums are going to be insane because the VIX is going to be high. Wall Street's going to be throwing money in the air. Everyone's going to be scared. Dumb money retail investors are going to be selling. You're going to do cash secured puts and collect premium after premium after premium after premium off of the debt that your tenants are paying. You feel me? And then all of a sudden you get in. Let's say the stock does drop down to 3 or whatever. You go ahead and do a covered call, and then you go ahead and continue chasing that beauty until you 5-10x, and then you're good to go. And then you could say, I'm a good citizen. I'm going to sell my stocks, and I'm going to go pay back the bank. No, let the bank hold the bag. It's a low interest rate loan. Buy more properties. Ladies and gentlemen, welcome to the game of Monopoly. Okay. Sadly, you'll never hear this explanation in school because I think the educational system has failed us. They should be teaching this instead of, y instead of this here, y is equal to mx plus b. X is equal to, plus, was it x? Is it, I can't even remember. X equal, hold on. X is equal to the opposite of b plus or minus square root. Wait, hold on. X equals the opposite of b plus or minus square root 4ac all over 2a. Look at all this bullshit, right? The quadratic formula. All this bullshit they teach you and that, honestly, did I get it right? Hold on. Let me see this here, right? Let me see this bullshit here. Oh, shit. You see, I forgot the b squared. B squared minus 4ac all over 2a. I forgot the b squared. Oh, boy. See that? I failed. I'm a failure, right? I'm a failure, right? So, anywho, You can see this bullshit, right? Screw this. Now, if you're a child, yeah, at least you should learn this. Learn how to think. But if you're in business, this is bull crap, dude. Little mouth there. All right. So anywho, big short squeeze come in. I don't know about that article though. Plus, you can cost segregate the homes for more write-offs. Absolutely. And you know how many write-offs you can do? Jesus Christ, the amount of write-offs you can do. You can, write off your plane tickets to travel to those homes to see first class, whatever. You know what I mean? So this was a kind of a messy drawing, but I hope it kind of, and I did this all on my mouse. Imagine if I actually had a pen. Oh God, it would have been like Harvard, So, saying to you guys, this is kind of how, Wall Street makes money, right? This is, how we, in our stock trades platform, how on the mastering here, we talk about how, we combine fundamental and technical analysis. Well, this is combining, the stock market and real estate together, right? So yeah, so it's going to be fun. We're going to have people in our stock terminal and mastering. You guys, we're going to have fun. We're just remember that money, money changes people. People become greedy. Luckily for me, I have the privilege of my background to kind of put me in place to remember where I came from, so I don't like kind of go become all greedy and all that crap that comes with all this knowledge. But yeah, that's it, guys. That's all I have to share with you. Take advantage of our SaaS sale. We have SaaS sale in honor of Clover, $1,000 off, and you can use Affirm too. Take advantage. Congratulations to all the people that signed up. Please sign up to the stock terminal. I don't know what you guys are doing. You're signing up, but you're not signing up to your lifetime access stock terminal. Okay? Sign up to the stock terminal. I think some people just buy it and they're busy. Like, I'm going to get to it later. Seriously, guys, get to it. You know what I mean? Learn this information, right? The bull market's coming, right? They say winter's coming. The bull market's coming. Okay? So, learn, take advantage, educate yourself, right? Education is the best vertical mobility, to be able to get out of your socioeconomic situation. Education is key. Overall, I'm very confident with Clover. See kind of where things are headed. Pretty good. So yeah, we'll go from there. I'll see you guys on the next one. God bless you all. And how you doing, Gunslinger? And awesome. Yeah, no, hopefully we'll be able to see her on here when I bring on people for lives in the future. That'll be fun. All right, folks. I'll see you on the next one.